Hello traders, this is John Kicklighter, Chief Strategist for dailyfx.com with a Forex strategy video in which we're going to talk about trading conditions and a particular type of trading approach that we can consider ahead of very significant event risk later this week. Now, it's a very fine line between picking tops and bottoms and playing corrections. They're technically the same thing, yet when we refer to picking tops and bottoms, there's usually a connotation of it being a lower probability scenario. However, we can do this in such a way that we can improve the probabilities a little bit more in our favor. And that has a lot to do with the knowledge of major fundamental event risk and a little interpretation or extrapolation from knowing how the market is going to react as a whole with that event risk ahead. So I want to take a look at a couple charts here with you. This is the EURUSD. Very remarkable drop to the downside. I traded this one last week, and it was one of the best trades I've had in a while. But I booked through the end of this past week and decided I did not want to hold it over the weekend because there was a strong probability that we can actually see a potential correction to the upside. All right. A similar situation can be established with the pound USD. Another really remarkable move to the downside. In fact, you can see from this consecutive bar indicator that we haven't had a move of this magnitude since back here in January. All right. So a very significant consecutive move down, and we are seeing a possible correction opportunity, but it could also turn into a follow-through event. So it depends on what the catalysts are behind this. And a third that has a lot of interest to me, and the one I'm more closer to actually trading, is the Euro-Yen. A very sharp correction there, 4 days down. We covered from up here at about 123.50 all the way down to 132.50. So we had a really remarkable 300-point move in the span of 4 days, and it falls within nicely here a broader congestion pattern, holding this technical floor very nicely. So what makes this a scenario where we can say that this is a good idea, or even a decent idea, to try to trade against a very remarkable momentum event like this? All right. There are a number of things we need to take into consideration, but from the standard perspective, we should at the very least see some level of correction, or at least a hold. We can see that we did hold this trend line, and we are seeing a little bit of a pullback. That is going to be a first approach. That is a first requirement, a technical requirement. We have a similar scenario here on the EURUSD, and we have the pound USD offering up the same. We have technical levels that have tentatively held, and we are seeing a little bit of pullback. However, that tentative hold could very easily turn into continuation. I'd like to call your attention back to this pound dollar move, where we had previously a 6 consecutive down day. It actually continued on to a more prolific bearish trend. So what is telling me that this is going to be a situation where we can see a rebound like we had on this particular 6-day decline, turn into a reversal, rather than this, a continuation? Because prevailing momentum, the prevailing trend, is inherently the more probable outcome. I think a lot of this determination comes from timing and event risk. All right, so the people that are on my my distribution list actually get this every Friday, the Manic Crisis calendar, but you can see very much the same thing in the Daily FX calendar itself. Knowing that there is major event risk ahead, which we do with very certain pairs, can be a curb on economic activity. All right, so looking through the first couple of days, Monday, Tuesday, we have notable pieces of event risk, including this EU economic forecasts, all right, RBA rate decision, ISM service sector report for the U.S., a number of policy officials speaking from the Fed, all right, notable event risk. But the big stuff, the things that can tap into the underlying themes of the market, come starting Thursday. We have the ECB rate decision, the U.S. third quarter GDP report, and then, of course, Friday's non-farm payrolls. Those are very important thematic pieces of event risk. They tap into the kind of considerations that have proven themselves time and time again to move the market. For the U.S. GDP and October non-farm payrolls, we know that this is exceptionally important for the U.S. dollar. In fact, last week, when we had the Federal Reserve decision come out, their decision to maintain a more hawkish bearing in their commentary, a more hawkish tone, there was a reaction from the market where the dollar was getting a pretty significant boost. So we have shifted the taper timetable from March, which is the leading consensus, to now something that is more evenly distributed to potentially a December or January taper. All right? That has been a big dollar-based pickup. All right? A shift in expectations. That in turn has led to the dollar rallying, which gave a lot of the momentum, or contributed a lot to the momentum, of the EURUSD and pound dollar, our two examples, or two of our three examples. However, continuation and building up on that particular theme really depends on the leading consensus. Will we continue to see those expectations for a nearer term taper build, or will they kind of adjust to whatever the information, the data is that we have on hand, and then stop in their tracks? That's the kind of concern that we have right now. But knowing that we have major event risk, like the U.S. GDP figure and like the non-farm payrolls, which can further illustrate or further define those expectations, that is going to be something of a curb on momentum. In other words, we think of the bigger players in the market, the people that have to manage billions upon billions of investors and deposits, capital holdings. Do they want to expose themselves to major risk with the dollar and its exchange rate, knowing that there is going to be these kind of event risks in the near future? Right? They don't trade for short-term scalping gains. They place their positions more for medium-term swings. Knowing that this event risk is here is going to curb their interest. And in fact, a lot of investors are likely to unwind risk, unwind the recent buildup in exposure that they may have adopted. Notably here, a possible dollar rally. So seeing that correction, seeing that unwinding of short-term dollar exposure can inherently lead to a rebound from the pound dollar and the euro dollar, as well as other dollar-based pairs. All right. Now the euro dollar is an interesting one, and this is where my interest is doubly significant for the euro USD, but it also illustrates very clearly what I'm looking at for the euro yen. Is the euro individually has its own exposure, so this is applicable to all euro-based pairs, but it is certainly stronger for the risk themes on the euro yen and the euro risk and Fed themes for the euro USD. Because you have to remember that with the taper speculation, we have a ebb and flow in risk-taking in general. But from the euro side of things, we're looking at an ECB rate decision on Thursday. And last week, one of the big contributors for the euro's rapid descent was a significant downturn in inflation data. All right, so the Eurozone inflation figures came out to a substantial 0.7% annualized growth. Previously, it was 1.1. This is well below the ECB's target and offers them plenty of room to adjust monetary policy in order to accommodate other problems that they're having in the region, like Greece's ongoing recession, like Portugal still on shaky ground when it's supposed to soon re-enter the market. Right? They can answer a number of problems should they introduce a new stimulus program. This is a risk. It's not realized. It's only a probability. However, knowing that that probability could be quite significant has led the euro to a significant downturn. But do you want to position yourself for, let's say, a rate cut from the ECB or a significant stimulus upgrade when it's still not the common approach that they have taken over the past months? There's potentially some correction to do here. All right? So when we're talking about picking short-term bottoms and tops, there is inherently a lower probability of success. However, when we're talking about major event risk that is naturally going to curb these kind of moves, curb this momentum that is necessary to reverse prevailing trends and to see risk aversion, or to see the dollar really pick up and rally. Those are counter trends. They need support. They need momentum to really overcome those uncertainties. All right? So in turn, we're actually going along with prevailing themes, not necessarily for the medium to long term. We're just picking pullbacks in dominant trends that are taking advantage of known event risk that much of the market is likely to respond to. They're going to remove themselves from that risk, and that can naturally feed into those dominant trends. Now, of course, this is not a sure thing. Nothing is in the market. But this is the kind of circumstance that we can put together between technicals and fundamentals to know that there is a higher probability that these trades could actually work in our favor. Now, as for how much we look for, that's always going to be a consideration, a concern. We have major event risk on Thursday and Friday, so inherently we would say from Monday evening, where we're at right now, into Tuesday and Wednesday, we have considerable amount of time. Let's say we have approximately 48 hours, maybe up to 72. But will we not necessarily find significant follow-through on a bounce from the pound dollar, or find follow-through on a bounce from the cable, or find a strong bounce from the euro yen? Should we target the entire range? One of the most famous sayings, and one of the most accurate: bulls make money, bears make money, pigs get slaughtered. Right? Looking for the entire range is probably not going to work with the time frame we have and the level of conviction. This is probably going to be a move that is more associated to a deleveraging of short-term exposure, those people that took advantage of the move to the downside like we did last week. So it doesn't necessarily confer a strong follow-through to the reversal. A lot of people are not just going to build up long euro yen or long pound dollar positions because it's counter trend, because that too will be curbed by the knowledge of the event risk ahead. Right? So we're looking for more corrective moves which don't necessarily cover the entire range. Now, of course, all of these pairs, all three, euro dollar, pound dollar, and euro yen, can all be undermined by a single fundamental theme if it decides it wants to rear its head, and that's risk trends. If, for some reason, we see a meaningful risk aversion theme where the markets are simply deleveraging exposure because of something that was unforeseen, the downdraft we would have in risk aversion would easily spill over into the US dollar, sending dollar rallying as a safe haven currency, and the yen crosses as expensive carry trades. You can see how high the euro yen is here, will unwind as well, along with all the other yen crosses. So there is certainly exposure, but seeing a market-wide risk reversal under the precepts that we do have major event risks that can tap into those risk trends, namely the Fed's taper timetable, it will be a lower scenario probability. This is why we talk about these concerns, yet we have to plan for the most probable scenario. All right? So that was a little breakdown of picking tops or bottoms, as we can see it on one hand, but really what we're talking about is taking advantage of market conditions and technicals when they combine. Right? So take a look at these pairs, take a look at the event risk, and absolutely be aware of all the major event risk and themes that we have due in that week. Good luck trading out there, guys. We'll do another Forex strategy video tomorrow.